The price of oil creeping past the $90 mark again isn't just a number on a trading screen. It's a signal. A signal that something deeper is shifting beneath the global economy. Every time oil climbs to this level, the ripple spreads everywhere. From the cost of filling your car to the price of groceries on supermarket shelves thousands of miles away. Energy sits at the center of modern civilization, and when it becomes more expensive, the entire system feels the pressure. For most people, the first moment they notice the change is at the gas station. A small increase suddenly turns into a painful jump on the pump display. But what's happening behind the scenes is far more complex than simply supply and demand. Oil is the bloodstream of global trade. Ships, trucks, airplanes, factories, power plants, nearly everything that keeps the world moving depends on it. When the price crosses $90 a barrel, markets begin to ask a serious question. Is this the start of another energy shock? Global oil markets are incredibly sensitive. A few million barrels per day, more or less, can shift the balance dramatically. Right now, production cuts from major exporting countries are tightening supply at the same time demand is rising in large economies. Nations like China and India continue to consume enormous amounts of fuel as their industries expand and transportation needs grow. Meanwhile, Western economies still rely heavily on oil, despite years of discussion about renewable energy transitions. The result is a market where demand remains strong, while supply is deliberately being held back. Major oil exporters understand exactly what they are doing. When production is reduced, prices naturally climb. This strategy can be extremely profitable for countries whose national budgets depend on oil revenue. A higher price per barrel means more income without necessarily pumping more oil from the ground. For oil-producing nations, maintaining that balance is a delicate game. Too low, and government revenues collapse. Too high, and the global economy slows down, which eventually reduces demand. Investors watch these movements like hawks. The moment oil approaches $90, financial markets react instantly. Energy company stocks often surge as traders anticipate higher profits. At the same time, airline companies, shipping firms, and manufacturing giants begin to face pressure because fuel becomes one of their largest operating costs. A single spike in oil prices can erase billions from certain industries while adding billions to others. The global market shock is less about panic and more about rapid rebalancing. Central banks also pay close attention to oil prices because energy plays a massive role in inflation. When oil becomes more expensive, transportation costs increase, manufacturing costs increase, and eventually consumer prices increase. This creates a chain reaction through the entire economy. Policymakers who are already struggling to control inflation suddenly face another problem. High oil prices can undo months of efforts to stabilize prices. This is where the situation becomes particularly sensitive. Many major economies are already walking a tightrope between slowing growth and persistent inflation. If energy costs spike too quickly, businesses may pass those costs directly to consumers. That means higher prices for food, clothing, electronics, and almost every product that needs to be transported across long distances. Oil might be extracted from the ground in one region, but its price is felt everywhere. There is also a geopolitical dimension to rising oil prices. Energy has always been deeply connected to international politics. When prices rise above $90, governments start paying closer attention to the countries controlling the supply. Strategic alliances, diplomatic negotiations, and sometimes tensions all begin to revolve around energy security. For nations that import most of their oil, high prices can strain national budgets and weaken their currencies. Shipping lanes, pipelines, and production facilities suddenly become critical assets in a high-price environment. Even the hint of disruption, whether from conflict, sanctions, or natural disasters, can push prices higher within hours. Oil traders constantly monitor these developments because markets move not only on actual supply shortages, but also on the fear of potential shortages. Another interesting factor driving prices higher is underinvestment in new oil projects over the past decade. Many energy companies reduced spending on exploration and drilling due to environmental pressure and the global push toward renewable energy. While wind and solar have grown rapidly, they have not yet replaced the massive energy demand that oil still satisfies. As a result, the world may now be facing a tighter supply environment than many expected. Demand for oil hasn't disappeared. In fact, global consumption continues to reach new records almost every year. Airlines are flying more routes again. Cargo ships are transporting record volumes of goods. Developing nations are building highways, factories, and cities that all require energy to function. Even electric vehicles, often seen as the future of transportation, rely on manufacturing processes and supply chains that still depend heavily on fossil fuels. This imbalance between strong demand and limited supply creates the perfect conditions for price spikes. Once the market senses that supply might remain constrained for an extended period, traders begin pricing that expectation into futures contracts. Suddenly, the price doesn't just reflect today's conditions, but also what investors believe will happen months from now. For consumers, this often feels sudden and unfair. One week, gasoline prices seem manageable, and the next week, they jump sharply. But the reality is that oil markets operate globally and react quickly to signals that most people never see. A production decision made in one part of the world can influence fuel prices on the other side of the planet within days. The psychological impact of $90 oil is also significant. Markets remember previous periods when prices climbed even higher. During past energy crises, oil surged well above $100 per barrel, triggering economic slowdowns in several countries. The fear that history could repeat itself often pushes traders to react more aggressively when prices approach these levels again. At the same time, some analysts argue that the world is more resilient now than it was in previous decades. Energy efficiency has improved in many industries, and some countries have diversified their energy sources. Strategic petroleum reserves exist specifically to cushion sudden supply disruptions. Governments can release millions of barrels into the market if necessary to stabilize prices temporarily. However, these measures are usually short-term solutions. They cannot permanently replace global production. If demand continues to grow while supply remains restricted, prices may remain elevated for longer than consumers expect. That possibility is exactly what financial markets are beginning to consider as oil pushes beyond $90. Technology also plays an interesting role in this story. The shale revolution in the United States transformed global energy markets over the past 15 years. Advances in drilling technology unlocked enormous reserves that were previously considered too expensive to extract. When prices rise high enough, these producers may ramp up output again, which could eventually increase supply and bring prices back down. But shale production doesn't respond instantly. It takes time to deploy rigs, hire workers, and scale operations. Investors also demand discipline from energy companies after years of boom and bust cycles. Many firms are now prioritizing shareholder returns instead of rapid expansion, meaning production growth may be slower than in previous price spikes. Meanwhile, the transition toward renewable energy continues in parallel. Governments around the world are investing heavily in solar, wind, battery storage, and electric vehicles. Rising oil prices can actually accelerate this shift because they make alternative energy sources more competitive. When fossil fuels become expensive, renewable technologies suddenly look much more attractive economically. This creates a fascinating paradox. High oil prices strengthen the profits of traditional energy companies in the short term, but they may also speed up the long-term transition away from oil altogether. Businesses and governments begin searching more aggressively for ways to reduce dependence on volatile energy markets. Despite these long-term changes, the reality today is that oil remains deeply embedded in the global economy. From agriculture to aviation, from plastics to pharmaceuticals, countless industries rely on petroleum products. Replacing that infrastructure will take decades, not years. As a result, every movement in the oil market carries enormous consequences. A surge past $90 is more than just a headline. It's a warning signal that supply, demand, politics, and economics are colliding once again. The world has experienced these shocks before, and each time they reshape financial markets, government policies, and consumer behavior in unexpected ways. The coming months will reveal whether this surge is temporary or the beginning of a longer cycle. If production increases or global growth slows, prices may stabilize. But if supply remains tight and demand continues climbing, oil could push even higher, potentially reviving memories of past energy crises. For now, the global market is watching closely. Traders, policymakers, corporations, and everyday consumers are all reacting to the same number climbing on the charts. Because when oil moves, the entire world economy moves with it. And at $90 a barrel, that movement can quickly turn into a shock felt across every corner of the planet.